Hey, welcome to the 40 Finance channel, everybody. My name's Jeff Beers. Haven't done a live stream in a little while, so I thought I'd hop on and just share with you just my opinion on where things sit right now. You probably noticed if you watch the channel that I haven't been posting as often, and that is really because I'm just in this sort of hold mode right now where I don't think, in my opinion, that we're going to have some massive fallout in the stock market. But to be fair, the flip side of that, it's hard to find a lot of super bullish thesis going forward. So for me, I've just been adding very small lots like I talked about on my last video where, I'm just sticking with the Qs right now. And I'm just adding little bits and pieces and just kind of waiting for this storm to pick up a track. Like, which way is it going to go? And obviously, for that to happen, it's really just about watching news. And there's so many market factors right now that I think it's really hard to put your thumb on which one is going to turn the ship around. And perhaps more importantly, when is it going to happen? So that's where, my thoughts are right now, and we'll catch up on some of the news. And if you're here and ask some questions, I'll get back to you on those. But as far as today, if you look at, we're here on Seeking Alpha. By the way, Seeking Alpha is having a mega sale. Definitely check that out. My affiliate link is in the description. You get a whole year for $99. Best deal by far that I've seen in a long time. But I put up the 1 month screen here in the top left corner. And you can see how, you should know this already, but, through August 16, 17, we were actually making a nice little rebound. And that's trickled out. And here we are in the doldrums again. And every time that Jerome Powell gets on TV, he seems to be preaching a very strong message to prepare for the worst and all those things. And I guess in my mind, the one out that we have, if it does, actually occur, which I tend to think that it will, is that inflation and consumer pricing is going to fall significantly in one of these months. Is it going to be September? Is it going to be October? Is it going to be March of next year? That's where you have to pick a side. For me personally, I feel like we are probably closer to that huge cliff where prices fall down just because the tightening is coming in so fast and furious. And the stuff that I read about retail stocks, we know that gas has already had one of its lowest trending months in a long time. I think that we are going to see that soon in the sense that people, number one, people aren't spending as much money. I think we know that, right? And number two, the retail reports that I read show that there is a lot of backlog. There's a lot of inventory. And that naturally, if you're running a store and you have a lot of inventory and you need to make money, you start to lower prices. So we could see that. We could see perhaps the biggest discounts in Black Friday history coming up if this trend continues. I mean, if you're a retailer right now, and let's just say you have a lot of computers or TVs, just to stay in the tech sector, it probably doesn't make a ton of sense to go full liquidation right now in September when people are not buying as much. But you can save that inventory for 60-ish more days and have a whale of a Black Friday. And nowadays, Black Friday isn't even the Friday after Thanksgiving, right? A lot of these cyber deals start in November 1st, perhaps even earlier. So it wouldn't surprise me if coming out of Black Friday, perhaps the CPI report that gets into that, maybe that will reflect some lower prices just because of all the sales bonanzas that I speculate will be coming together here in Christmas. If you're a retailer, how you doing, Kevin Hawthorne? Good to see you. if you're a retailer and you're struggling, you're coming up into the best quarter to turn things around. Okay, so Bed Bath & Beyond is super popular right now in the news headlines, but let's just think about Bed Bath & Beyond for a second. If they are indeed struggling, it's not a stock I follow, so I don't have much of a comment there, then heading into Q4, which is October, November, and December, it is the best time to be a retailer because of holiday shopping, and it's the best time to get rid of excess inventory. And we've heard Target talk about excess inventory and probably dozens of others. They're approaching that time period when they can get rid of those things and build a customer base, customer satisfaction at the exact same time. So watch out for Black Friday. I don't know how strongly correlated a Black Friday sale is to necessarily like the full CPI report, but I think what you're going to see is the era of the bargain hunter is going to come back very, very strong. And I see that as well for stocks. Just from a sheer, let's take a look here at the QQQ since I talk about that all the time. Okay, so here's our 1 month view in Seeking Alpha. And our peak last year, ironically, came in November. Or that's not the full peak, but the last bump up, the last mountain that we were on was in November and December. So was seasonality a part of that? It's hard to tell. But we also know that coming into this year, the Fed got a lot more iron-fisted, if you will. But now we're heading back into that season. So will seasonality play on this at all? I'm not sure. Jordan, good to see you. But from my vantage point, we know that some earnings speculation is coming down. But let's take a look at that for a second. Let me get into, I'm just going to use this. I also use this a lot on the channel. This is all the holdings of the QQQ, right? And let's go to earnings. That's, what am I looking for here? I am looking for the growth tab. Okay. And then let's go over to forward EPS. And this is percentage growth. Okay, so for all, and it is based on projections. So just to be fair, this number, as you know, will probably come down because we are seeing a lot of earnings projections coming down. But I do stand by the fact, and Apple's a great example, that these numbers are still double-digit percentage points above the year before. And with Apple, they're such a great case. Apple is really the epitome of where stocks are right now, okay? Because you have a lot of concerns in Apple world about how well will these new products sell. They just had their, it's not Investor Day, but Product Day. Let's see if I can get some news on that. Apple event. Okay, so Apple event largely met expectations. And what they did is they came out and sort of like the past 3 years, it's kind of been the same dog and pony show. You've had updates to iPhone, Apple Watch, and AirPods, okay? And the overall sentiment, at least from this Morgan Stanley, the overall sentiment, we see limited impact to September seasonality given the other 3 iPhone 14 models are being released 1 week earlier than normal, and maintain forecast for 51 million iPhone shipments in the September quarter. The analysts added that another important takeaway, perhaps the biggest, was that Apple kept like-for-like iPhone pricing unchanged. the iPhone 14 and Plus starting at $799 and $899, while new iPhone Pro and Pro Max starting at $99 and $1099. This may be important to watch as the global economy gets weaker. Okay, so there wasn't necessarily a price hike, is what it sounds like to me if you go model over model, but some of the features improved. And what we always try to speculate on Apple, that's very hard to do, is are the new models providing enough feature upgrades for people to churn, right? To come over, leave their old phone behind, upgrade to the new one. What I'm seeing, the way I look at this with Apple, is even if sales are flat, okay? Let's just say sales hit projections. Let's say that revenue misses a little, maybe a little slightly, maybe EPS goes up because they are becoming more profitable with things like services and whatever. If they just sort of hit the bar, then you throw that in with their stock buybacks and the fact that more and more people on the services end continue to sign up for more and more things, it could still be a bang quarter for Apple. They don't necessarily need to sell plus 10% iPhones over the guidance because of the way they do buybacks and everything else that they're running. So I saw an interesting article, I think it was on here. And it talked about the galaxy of Apple versus Android. I have to go through here. Oh, and we didn't talk about advertising yet, but that's in there too. Here we go. iPhone crown. Over half of America is using smartphones made by Apple. So if you follow this game, which has been going on for a while, Android has a ton of international share. But what you see with iPhone here in America, America's the most valuable market, and Apple is now plus 50%. According to Counterpoint Research, Apple has surpassed Android, whoa, I did a mouse over there, to account for more than half of all smartphones being used in the United States. iPhone has even been growing at 5% over the past few years, up from 35% in 2019 to 40 to now 45 in 2021. So when you think about the snowball effect and how that has been growing, it doesn't always mean that the newest phones will sell as much as they're expected to, but this user transition, which continues to get stronger for Apple, it feeds the snowball, right? Across the board, it feeds the snowball for the accessories, for the services. So sometimes we get really, really focused on the units that a particular technology provider sells. But what we don't see in the background, and what I think is happening right here, is just the snowball is getting bigger and bigger. We go back, I made that passing point on the advertising business. And this is going to be something that, in my opinion, could really turn out to be interesting with regulation. So we know what Apple's done as far as tracking. And what it's really turning into, as we're starting to see now, is it's turning into a win for them. It's not, it has probably very little to do with consumer privacy, although, that's the headline. However, their online advertising, of which now they've walled this garden off, right, is getting bigger and bigger. So adoption of Meta platforms, Facebook, fell 3 percentage points to 82. That was not the sentence I thought it was going to be. The report, which looked at online advertising spend of consumer app companies, found that adoption of Apple's search ads has grown nearly 4 percentage points to 94%. Okay, so these are advertising dollars, which we know that advertising dollars are probably in trouble right now, just because consumers are pinching pennies, and in a corporation, advertising is always the first thing that gets chopped off. But what's interesting for Apple is they don't necessarily need advertising budgets to grow if they steal market share, because that means that their advertising revenues grow, and that's what seems to be happening. So bad news for Facebook, probably in the short term. Good news for Apple. And going back to the snowball theory, this is just yet another thing that Apple is doing to pull money out of their existing user base. And this is a philosophy that has worked well for them for a decade now, if probably more than that, probably 3 decades. And they're continuing to build on it. So frankly, I didn't see this advertising line really to be a top topic like it has turned into, but it all sort of makes sense. They've walled off their garden, triple walled it off. Now they're going to turn the App Store and some of those related features into, advertising areas, and all they have to do is pull market share, not new dollars. They just need to pull market share, and considering where Apple stands in the United States with growing a user base, it's all coming to fruition. So if you're in the queues like I am, if you're in Apple, I'm not saying this thing is skyrocketing, but lately I've been feeling much better about where Apple will land in terms of earnings and guidance, because and that's important because Apple has such a percentage hold on the stock market. I mean, it's roughly 10 or 12% of the Qs. God knows what it is in the S&P 500. As long as Apple does well, the stock market is not going to tank to infinity. That's my 2 cents. All right, so Jimbo Jones is here. I know you like TJ Maxx a lot. Wonder if that could explode over the next few months. So I did, and this kind of gets back to my portfolio on TJX. I do think that they're going to be in good position given the way the market is right now. And again, this goes back to my current outlook. I've been plucking off some wins because I have so many losses that don't look like they're going to come back to life anytime soon. So I did sell my TJX position, mostly because it reached the $65 mark, and this is something that happened. So you see right here, it must have been back in mid-August. I know that mine was about 65, 66. So it reached a high of 70. If the market bounces back, 75 is probably not out of the question. I held it for 2 or 3 years, so I also got dividends in that time. I think my cost basis fell to, it was in the $48 range. So TJX was a good stock. I have been very worried about which way the market could go. I'm staying invested and I'm staying bullish for the long term. But if you've watched some of my videos, you may also know that I sold another stock that I really like, but it gave me an opportunity to book a win, and that is Visa. So Visa reached 215, I think is what I sold it at. There's 214, maybe somewhere in here. Must have been mid-August again. So I know I was waiting for 215, and it's not that I don't think Visa could go up higher, but I want to set myself up from a portfolio standpoint. If this keeps going on, I have so many losers. In fact, with chopping off some of my winners, I have basically nothing but losers right now. And so I wanted to take the gains because at the end of the year, I'm going to have to pick a couple of these loser stocks that I'm in that have cost me a lot of money. And if I want to sell them at the end of the year for the kind of tax loss harvesting, I thought it'd be a good time to book some wins. That way I can balance it out, right? So that's kind of how I approached it. I booked wins in TJX. I booked wins in Visa. Also this year, thank God, earlier in the year, I sold Taiwan Semiconductor for a small win. And I think that's it. I sold Amazon, but I didn't really win on that. It was a flat. It was literally a couple $100 or something. So I locked those in just because of where the market goes. Now, there's plenty of other ways you can look at it, right? You could have said, geez, if you like Visa so much, hold your winners, let your winners win. Same with TJX. I was trying to get the old bird in a hand. It is better than three in a bush or whatever that is. So I wanted to book it and make sure that I had wins so that when I will eventually sell some of my losers, if this market continues, and that will offset my gains and give me a wash, hopefully through the end of the year. So I hope that helps. Jimmy T asked, when will the banks skyrocket? That's been a really interesting one. I'm surprised. So I think, let's see. So I've almost bought Ally a few times. They're not the best of the banks, but I use them. So, and they have the dividend and everything that other banks offer. And it's funny going into this year, right? Because everybody said interest rates are going up. The banks are going to make a ton of money. Get into banks as much as you can. If I remember correctly, that was like the CNBC calling card between the Fed's first interest rate hike through, March or so. And this is Ally Bank. There's other ones, but you see what's happened. They've actually cratered under the guise of higher interest rates, make them more money. So I would say, Jimmy, I don't do enough bank research, and I probably should. Okay, I don't get into the financial sector as much, but screw Ally for a second. You'd have to wonder JP Morgan. Let's see what their world is. Same deal, man. When all the figureheads were saying buy, 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 excuse me, well, that's November. Let's go year to date. Everybody was saying buy, 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 but overall market weakness brought this down more. You got a PE of 10. Let's see. Let's compare this to the sector. So I think we can do, I just have to get to the right screen here. Valuation. Okay. So again, this is on Seeking Alpha. And in banks, you can probably do this pretty well. Check the valuation versus the sector. So trailing 12, let's just go to GAAP because we're talking about banks here. Let's not fiddle with non-GAAP. Trailing 12 months, they got a B minus on Seeking Alpha scores, but relative to the sector, so 1061, they were right in line, looking backwards to the sector median. Now, unfortunately, do we have a forward? We don't have a forward. That's interesting. Oh, that was forward. My fault. So they're right in line with the sector median. So this is where you have to say JP Morgan as a standalone stock, is it super cheap? I guess if you look to this 5-year average and you say that their forward PE was typically in the 12s, close to 13, but it's certainly not cheap compared to other banks, is how that I would personally look at this. Now, does their multiple increase to the standard 5-year average of 12.72? Perhaps, but let's see, what does that really do? Trying to find what their earnings projection is. Okay, so earnings estimate here of 11.15, forward PE, which we just talked about, 1064, and we said the 5-year average was 12. I have to get out my calculator off to the side, but 11.15 times the 5-year average, which I believe was 1272, close enough, That is a price of 141. Okay, so if they get to the 5-year average, which is anyone's guess, this could potentially hit $141. The question or the risk, I guess, that I see is, will those multiples return? So I don't know. I look at it and I say JP Morgan, which is a company, to be fair, that I do not follow super closely, except for, Jamie Dimon gets a headline every time he comes on TV. But I will say about JP Morgan is I feel like it's a fairly trusted stock. And they're in wealth management, so that's always good because people don't typically move millions of dollars around in wealth management every time the wind blows. So maybe there's another $20 in here, but you're betting on the interest rates or whatever the argument is, that they outperform their EPS, and then you're betting on banks getting back to the 5-year average on their forward PE valuation multiple. That's the X factor. Now, JP Morgan, let's just call it for 3 years. I don't see how they don't do better, right? But I think the instant boost to interest rates that everybody thought was going to help banks, that certainly hasn't come to fruition. And then the scary thing, and one of the reasons I haven't bought Ally, is because Ally does a lot with cars, auto loans. They have a decent chunk of auto loan business. And I'm a little worried about repos in the auto loans because of how much people paid for cars. Gee whiz, like some of those sticker prices that I see out there, is it six? One, yeah, is 6 figures, for a premium SUV. And premium doesn't mean Range Rover. A premium, I'm talking about GMC, Chevy Tahoe, that kind of thing. I can see some repos coming to the car world, and if that does happen, even a minor bump, right? Even a minor bump in repos could put some rain clouds on what the banks are trying to do. So I'll leave it like that. So just be careful. To answer your question directly, when will they go to the moon? Looking at JP Morgan, I don't see it in the short term. But there's a lot worse investments than JP Morgan in this particular environment. If anything else, if you're in it for the dividends, 3.37%, I just don't know that it's just going to jump out of nowhere and go to, say, $150 or $60. That to me would be surprising, but we'll see. Great stock Vortex started a position in Fortnite. Fortinet. My kid plays a lot of Fortnite. I like Fortinet. I really do. Got it under 48. I like it better than Palantir because it's profitable. I would agree with that. I own Palantir and don't own Fortinet. But I will say, if I can type this in correctly, it is a company that I like as well for the same reasons you do. Profitability. Let's take a look at their earnings projections. And if you don't know Fortinet, they're sort of like a dinosaur, which is a weird word to use. They're a dinosaur in cybersecurity in the sense that they've been doing it for a long time. And that's one reason that they're profitable. And I think, there's a lot of people that will say, I'm just going to pick, CrowdStrike's incredibly popular on the flip side because, there's people who are going to say CrowdStrike's, let's just say technology, they're going to overtake Fortinet. But what people miss on Fortinet is they're so in on the corporate level. Okay, and if you run a company like this, let's think about the IBMs of the world. Let's think about AWS. Once you get ingrained in a corporation of size, how about let's just pretend that AWS and Fortinet are serving Procter & Gamble. Perhaps, take your pick. Procter & Gamble, super big company. They don't just wake up tomorrow, pull the plug on the contract, and go sign up with CrowdStrike. If you haven't sat in corporate purchasing processes before, it is absolutely painful. So I feel good about Fortinet continuing to build. It looks like if we just go straight EPS estimates, 2022, they're offering 31% growth. And then you have plus 23% growth projected for next year. And then on the revenue side, I mean, you're double digits, right? You're double digits across the board. I did not look. Do they play? No, they don't pay a dividend, which is great. I wouldn't figure if you're growing double digits that you should be paying a dividend. But great stock, Vortex. I like the pick. Obviously, it's probably 3 or 4 year hold, which is where you should be. And anytime you're buying something like this now, and you know that Fortinet is not going to go through massive ups and downs in their stock pricing, but I like it, and best of luck to you. Jimmy T, thank you for your time. Oh, and the explanation. Looks like I can't quit my job today. Well, we're all in the same boat. So on the good news, Jimmy, I would rather have your JP Morgan than some of my stocks like Palantir right now. Because, let's take a Palantir. I still believe in the company. I'm not backing down from that. And it's for a lot of the same reasons that I would support a Fortinet purchase. Once this type of technology gets built into these companies, particularly the freaking government, okay, it's not going to go anywhere. Now, the problem, of course, with Palantir, and I was a sucker for this, it's not that Palantir, I think, is a bad company. It's just I paid a stupid price. Bottom line, I got sucked into the hoopla. I paid a stupid price. I'm at $20. And what I really need to be doing is probably chipping away at that dollar cost average and still holding on to it. But where I'm at is particularly from a liquidity standpoint, with a lot of stuff going on with family, with back to school. I've talked about this before. It's an expensive time to be me with family obligations. And of course, your first thing is the sort of Pavlov's, cycle of needs. We have to pay the mortgage. We have to eat groceries. We have to do our thing. So my extra money outside of retirement funds, my extra money that I've been putting into the stock market, like so many of us during COVID, I had a lot of extra money. And I was able to build into that portfolio more. And here we go. Similar story that a lot of you are facing. My extra income at this time of year is low, right? I can't just buy everything, every dip I see. And here we go. The stock market is hurting. So all the best deals are out there. I don't have a ton of cash. I'm being reasonable with my cash because I have to keep the savings account. Anytime you have kids and houses and whatever, you have to be able to pay cash in an emergency. So I have that on my side. What I don't have is $5,000 falling out of my wallet that I can just come over here and buy 100 shares of Palantir for less than $800 to lower my cost basis. Doesn't make sense. What I have been doing is picking off the Qs. Okay, because the Qs are down. And Palantir, I don't know how well represented that's going to be in the Qs, if at all. In fact, I see right now it's NYSE stock. But Fortinet is going to fall into the Qs. So let me see this. Oops, NASDAQ. Oh, that's not, gee whiz. NASDAQ index. What I really wanted was NASDAQ holdings. Actually, I wanted Q holdings. 1, 2, 3 holdings. Here we go. I knew I had this bookmarked somewhere. Sorry for the delay. All right. So, what I can afford to do right now is with the market being in a downtrend, I can afford to buy miscellaneous shares of the Qs. I do not want to group this by sector. And what does that get me? Okay, we talked about Apple. We pretty much all know the top 10, 15%, right? So if I spend, call it $100, just to make this easy, right? If I put $100 into the Qs, which would be a partial share, 13 of those dollars go to Apple, technically, and then the rest, but I'm also getting tiny slices of NVIDIA, Pepsi, Costco. Fortinet's got to be in here. Control F, FTNT. There it is. All right, 37 cents. 37 cents of my $100 into the Qs goes to Fortinet, right? And obviously people are in better situation. They buy $10,000 worth of the Qs. They are getting, I should be able to do that off my head, but 10,000 times 0.37. They're getting $3,700. That's not right. $370 worth of Fortinet. Okay, so this is why, if you question, and some people do, what in the heck am I doing with the Qs in this kind of downtrend? It's because I just know without looking, I'm getting slices of some really good companies that are down right now. And I know that with the Qs, I have two options. And this philosophy is, you could do this with the SPY. You could do this with your favorite Vanguard fund that's a little bit broader. I just happen to like technology, and they also have consumer discretionary in there, so that's why I chose the one that I have. But there's no reason that you can't do this with the SPY, and the fact remains that the market's down, you're getting bits and pieces of companies that are also down, and then more importantly, and something that I came to a realization on this downturn, is that the shares of the SPY and shares of the Q, once you get to that 100 number, once you get to that 200 number, obviously you have the options game, but you are not going to face the same roller coaster ride with the SPY and the Qs that you are going to face with Palantir, right? So at the end of the day, my retail account, my taxable account is supposed to be, in theory, almost a savings account that grows faster than a savings account. Now, the problem being, over the past year, like everybody else, not really a good tool for saving money, but I also have time on my side, right? So Palantir, 772, right there on the screen. Not good for my shares at $20, but you got to think about not good for a second and say, well, it's not good looking today, but I don't need to sell it today, okay? And that's the important part. I don't have enough money to buy more, but I don't need to sell it today. My NASDAQ, my Qs, and I also do the TQs. I think my Qs are at 358-ish. My average shares, about 51 or 2 shares that I have. Qs are 305 or something. We just looked at it a second ago. Right here, right? So I'm give or take 15% down on the Qs. Not good, doesn't look good on the portfolio view, but I don't need to sell it today, right? And we know that 3 or 4 years from now, it's probably not going to be $300, right? It's probably going to go up. So be careful. I can't really say do it my way because I'm swimming in red. But, to be fair, what my portfolio shows, which is a ton of red, versus what I've clipped off this year to book and wins, they're really two different stories. And that's why when I do a portfolio update, I always have that goofy Excel spreadsheet that I show you guys like the total, like how much money was put in, where we are today, blah, 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 because that's how you have to think about things. If you're waiting for Palantir to get back to 20 or any stock like it, hard for me to imagine that scenario prior to 2023. But I don't need to sell it today. So as long as the company, still matches what you think it will be, then, turn off the news, man. Turn off the YouTube. Go look at something else. If you're me, this is, in addition to being an expensive time, it's also a very busy time for my other business interests, some of which relate directly to back to school and school being in. So I've just been busting my balls on making more money. And, sadly, YouTube is not a huge money maker for me. So I haven't had to double down on that. But I've been focused on making more money. And I think that's all you can really do for the next 3 to 6 months as investors is maximize your income, slowly but surely pick off things that you believe in. For me, it's been the Qs. For you, it could be the SPY. For others, it's a dividend portfolio that guarantees them returns of some kind. Make more money, chip away at those goals, and one day we're going to get on here together, and we're going to see, hey, look, the market's trending back up. When is that? Is it January? Is it March? Is it September of 2023? Is it September of 2024? Nobody knows, but we do know that if we pick solid U.S. companies that have a track record of growth and innovation, we're eventually going to be in the green again. All right, Jimbo, when do you think the market will rebound for good? Sideways or down through 2023? I kind of like that thought, sideways or down. It really would, like I was saying earlier, when I think about the Black Friday season, when I think about CPI prints coming down, I'm not saying that that'll affect the Fed until, I don't think the Fed is going to suddenly change their stance anytime before the end of 2022. But I think the market will feel better when those CPI numbers and everything related to them, inflation numbers, etc., when we start to see real progress. Right now we're seeing progress of like 0.6%. It's barely noticeable, but flat is better than up. But I think by the time we get to November, December, we'll start to see percentage points off of that. Is it going to be an inflation number of 2% or whatever Powell's waiting for? I just can't imagine. It'd be so hard to imagine that. But I'll tell you that the rest of the investing world, myself included, if we saw 8% come down to, say, 5% by the December headline, which would be November's numbers, I would be like, man, this is great. This is great, and we're not there yet, but I feel pretty good heading into summer of next year. So your point on sideways to down through the first part of 2023, did you say first part or full year? And now I can't find the comment. But I think that makes a lot of sense, right? And then summer of next year, where do we stand? It's hard to figure out. But we know that the worst case scenario heading into next year is if some of this change that has come about because of inflation, higher wages. I saw Social Security cost of living increase next year was, I want to say 8%, SSA COLA 2023. And all these clickbaity headlines, 8 to 10%. Okay, so again, payroll or pay scales, COLA for Social Security for the old and retired, they are getting more money next year. And then if we actually do get inflation coming down to call it, how about 5%? Let's just say 5%. Then you're starting to win as a consumer, granted by, tiny little dots, but you are starting to win where the changes in the world for inflation are starting to go in your favor instead of keeping you at par. So, how about housing is obviously a big concern. Housing, there's no way in heckfire that housing goes to 2019 levels. There's absolutely no way. Do the prices come down? Yes. Think we're already seeing it. Will the days on the market come down? Yes, they will. Or, go up? Yes, they will. I don't think you need to be a soothsayer to figure that out. But if you think quality housing is going to fall to 2019 levels on a price per home, you're crazy, because people will just stay in it, right? They're the guys and girls who have locked in their interest rate at 2 or 3%. They've lived in their house. I've lived in my house for 10, 12, 13 years, okay? We have a great interest rate. So if you think that housing is going to go down 20% and then I'm going to sell my house, hell no, absolutely not. So the shortage is going to exist and prices are going to stay inflated, just not at this level. That's my 2 cents. All right, Great Stock Vortex, CRM at 198. I'll put them in the Fortinet crowd as far as companies that I do like. I get my nice little piece of them. Actually, I don't. It's NYSE. I thought for sure they were in the NASDAQ. You're at 198. Let's just rely on earnings estimates. See what we got. All right, so this year, which don't be fooled, this is their fiscal year ends in January. So somewhere in the neighborhood of February, you're going to hopefully hit this 474. Okay, 4P of 33, a little high right now, but maybe they keep going and you see it was negative growth. This is what we need to get back to for Salesforce. You got to get back to double-digit growth, okay? And I think they're entirely capable of that. You already have double-digit growth speculated for this year, but we need to keep those numbers going. So I haven't read a CRM investor report in a while. Let me see if we can get the most recent. Lowered guidance. Okay, August 25th. Finished down as the cloud computing software lowered its full year revenue forecast due in part to foreign exchange. I would need to go through their investor report more, but I will say with Salesforce, it's a matter of time before they bounce back. One thing, I'm just going to make a broad intuition here. The key fundamental for purchasing and keeping Salesforce at your company is for corporate sales, right? This is a really weird environment for corporate sales, B2B sales, whatever you want to call it. The combination of inflation, the combination of logistics costs has more than likely brought down things like advertising spend, what's the word I'm looking, capital costs or capital appreciation. That's not the word I'm looking for. Spending in terms of, it's going to kill me, that word. Anyway, projects to grow the company. It's passing my brain, but all of that type of spending, okay, is coming down slowly. So if you're selling in a B2B space, it's a really crap time to be selling B2B. So which of course is there's not going to be a huge demand to expand your Salesforce implementation, because quite honestly, it's probably hard to sell things, right? This isn't the time. This isn't the time when people are going to, let's just say, switch over to AWS. Let's just say they're hosting inside their own company. They're using servers or they're on some antiquated system. This isn't a really good time to say, you know what, guys, right now when things are tanking, right now when we've got margin pressure due to increasing costs, let's go out and book a $5 million AWS contract. Nobody's doing that, okay? And that kind of world is got to be back in CRM land where the sales cycle is stalled, so the need for their software is stalled. Now, a good salesman is always making contacts, right? Is always checking in. They know it's a long game. But I foresee that when some of this inflation stuff, passes, at least at a reasonable level, and particularly logistics costs, let's see CRM's back into growth land. It's just a really, really hard time. I think it's a quality company. I think, it's a profitable company, first of all, so you could do a hell of a lot worse. Are you going to get to 198 this year? Doesn't seem. Here's when you're going to get to 198. I can tell you just by looking at this chart. If you get back to 198, it is going to be when we get out of this crap. So call it February when their next earnings call is, or when they report the full fiscal year, okay? Hit the 474, okay, we were flat to negative for the year. That year is over. They got to come out and do this, guarantee this, 565 or more in 2023. That's when things start to take off and you get back closer to 198. Revenue obviously will play in that game too. The worst case scenario is they come in here on February of 2023 and they say, let's just say they hit 474, but they say, hey, the 565 you guys were guesstimating, we're not going to get it. We're going to get to 525, which is still a 10% boost, but it's going to drag their multiple down. But I would hang on to Salesforce for the long. I would hang on to them through 2025 easily because this downturn cycle is going to turn back around. My 2 cents, as always. Padruco, what about TQs long-term since you like Q? I have TQs long-term. That is something that is negative for me, and I share that all over the place. I just did a video. 29.59. If you're curious, I think I'm at 48 is what I want to say. I'm at 48. This is another one that I pepper in. Right now, because of the market, I'm doing, the last time I made a purchase, which was last week, I bought 1 share of regular Qs for give or take $300. And then I bought 5 shares of TQs. So, dollar for dollar, it was 50% of what I spent on regular Qs. And that's only because, not because I'm not as bullish, but I really want to get to my 100 shares of Qs because there's some sanctity or sanity in that space in terms of having options. And then also just like a foundational element to my portfolio. Instead of continuously losing on these small cap stocks, I'll have this foundational element that I just know, yes, it could go down, but over the long haul, I don't have to worry about it because it's not a single stock. It's going to go up or else the world's going to have much bigger problems and every stock's going to go down. Damien says, good moat for CRM. I agree with that. Great stock Vortex is 5+ years. So I wouldn't even sweat it. I could see some more storm clouds based on everything we just said. But 5 years, I wouldn't even sweat it. All right, guys. That's about it for today. It's good to see you. I will get back to posting recorded videos. Like I said, there's just a lot going on right now, and I have more money to be made in other places is one way to look at it, but I'm still in, I'm still investing, I still believe in the Qs, I still have my portfolio. The only thing that I sold out of was winners, and that might have been a dumb way to do it, but I booked some wins with Visa, TJX, and then early in the year I had a couple others. But all of my colossal losers are still my colossal losers. I still own them. Nothing's changed there. And I don't project the way this thing is that I'll sell my losers while the market is losing. It's just not something I'm going to do. So I hope your portfolios are doing well. I appreciate everybody for coming out. Don't forget to check out that Seeking Alpha special offer in the description with my affiliate link. Thanks to everybody again. Have a great weekend. We'll see you on the next video.